Imagine a company whose main business is buying crypto with other people's money. You don't get a seed phrase. You don't get private keys. You get a stock ticker. That's the basic idea behind crypto treasury companies like Strategy, formerly MicroStrategy, and BitMine. They can be useful. They can give investors exposure to Bitcoin, Ethereum, or other crypto assets through public markets. But they are not the same thing as owning crypto yourself. Hey everyone, Serena here from Stack Wallet. Today we're talking about crypto treasury companies, why they exist, why someone might buy their shares instead of holding crypto directly, where they get the money to buy crypto, what risks they create, and why the cleanest form of crypto ownership is still holding your own coins in your own wallet. First, what is a crypto treasury company? Normally, a company keeps spare cash in bank accounts, money market funds, or short-term government debt. A crypto treasury company says, we want our reserve asset to be Bitcoin, Ethereum, or another digital asset. BitMine is one of the best-known Ethereum examples. Instead of investors buying Bitcoin or Ethereum directly, they buy shares in a public company that holds a large amount of it. So the company becomes a kind of wrapper around crypto exposure. So why would anyone buy shares in a treasury company instead of just buying Bitcoin or Ethereum directly? The simple answer is, they want crypto exposure through the traditional financial system. Some people can buy stocks easily through a normal brokerage account, but they do not want to deal with exchanges, wallets, seed phrase, or private keys. Some funds, retirement accounts, and institutions may also find it easier to buy a listed security than to hold crypto directly. And for some investors, the public company wrapper feels more familiar. They get audited financial statements, security filings, corporate governance, and a stock ticker that fits neatly into the system they already use. There is also a more speculative reason. Some investors are not just betting on Bitcoin or Ethereum. They are betting that the treasury company's financing strategy can outperform simply holding the coin. For example, if a company's share trade at a premium to the value of its crypto holdings, it may be able to sell new shares, use that money to buy more crypto, and potentially increase the amount of crypto backing each share. That is the pitch. But notice what changed. You are no longer only betting on the asset. You are also betting on management, share issuance, debt, market timing, custody, investor demand, and whether the stock keeps trading at a premium. That is exposure, not ownership. Think of it like buying a ticket to a company that owns a giant vault. You may benefit if the vault gets more valuable, but you do not hold the key to any box inside the vault. A self-custodial wallet is different. That is more like having your own safe with your own key, where you control what goes in and what comes out. Both things may have a place, but they are not the same thing. So where do these companies get the money to buy all this crypto? A few places. They can use cash from their existing business. They can sell new shares. They can do private placements where new large investors buy newly issued stock. They can do private placements where large investors buy newly issued stock. They can use at-the-market offerings where the company gradually sells shares into the market. They can issue convertible notes, debt, or preferred stock, which is a special class of shares that often expects dividends or preferential treatment. This is why these strategies can grow so quickly. But it is not magic money. Every new share can dilute existing shareholders. Every debt or preferred stock obligation adds pressure that has to be managed later. Now let's talk about risk. The first risk is simple. Stock exposure is not coin ownership. If you buy a crypto treasury company's share, you own a claim on the company. You do not own crypto in your own wallet. You cannot take those shares, open Stack Wallet, and spend them on-chain. You are trusting management, custody arrangements, financing decisions, regulators, lenders, and the stock market's mood. The second risk is dilution. When the company sells new shares to buy more crypto, the company may own more crypto overall, but existing shareholders now own a smaller percentage of the company. That might still work out if the strategy succeeds, but it is not the same as simply buying and holding your own Bitcoin or Ethereum. The third risk is leverage and reflexivity. When the stock trades at a premium, the company can sell shares, buy more crypto, and make the story look stronger. But if the stock falls, financing gets harder. Buying can slow down. Debt or preferred stock obligations may become more stressful. And in some scenarios, a company may need to issue more securities or sell assets to meet obligations. The fourth risk is concentration. large corporate treasuries can become powerful buyers. That can bring attention and liquidity to crypto. And philosophically, it pulls crypto ownership back to corporate vaults. Crypto was built so that ordinary people could hold digital assets directly. Treasury companies reintroduce a layer of corporate control between the person and the coin. Here's the honest bit. Crypto treasury companies are not automatically bad. This is not a call to buy or sell them. They can bring attention, liquidity, and institutional access to crypto. For some investors, they may be the only practical way to get exposure inside traditional markets. They may also fit neatly into brokerage accounts, reporting systems, tax systems, and portfolio tools that investors already understand. But they are still a financial product wrapped around crypto. That wrapper adds management risk, dilution risk, debt risk, premium risk, custody risk, and market structure risk. So the important question is, what do you actually want? If you want price exposure through the stock market, a treasury company may give you that. But if you want crypto itself, the cleanest version is still direct ownership. And direct ownership means private keys. With a non-custodial wallet, you hold the seed phrase. You control the coins. No treasury company, exchange, broker, lender, or board meeting has to approve your transaction. That also means responsibility. If you lose your seed phrase, there is no password reset. If you send funds to the wrong address, there may be no one who can reverse it. But that is a trade-off at the heart of crypto. Less dependence on intermediaries, more control in your own hands. Not your keys, not your coins is not just a slogan. It means that unless you control the private keys, what you really have is a claim on someone else's system. Stack Wallet is built for self-custody. It is open source, non-custodial, and privacy-preserving, with mobile and desktop options. So by all means, learn about crypto treasury companies. Understand why they exist. Just don't confuse owning a stock ticker with owning crypto. A treasury company gives you exposure through someone else's structure. A self-custodial wallet gives you control through your own keys. If you want the coins, hold the keys. Thanks for watching, and I'll see you in the next one.